So markets are back up. Tried to touch a high today, but this is something to be concerned about. In terms of the investment outlook, the question is, where in the world do we invest now? Well, over the last 3 years, what we've really seen is kind of an American age. Between 2010, and we did a State of the Union, if you remember, called America Rising, and it really did play out this way. People were really concerned over the last 3 years about Europe blowing apart. They were really concerned about the power changeover, the hard landing in China, and so there was a rotation back towards U.S. equities. And because of that, the U.S. equity market in blue actually outperformed all the other markets in the world combined in green by about 30 percentage points. So the question now becomes, one, is this warranted? And two, is it sustainable? So in trying to predict future stock market returns, which is quite hard to do, the question is, what variables really matter? This is a study that Vanguard put together that came out in the middle of the year last year and simply asked what variables matter, what are the correlations between a certain variable and the return of the market 10 years forward, okay? I think that the answers to this might surprise you. So for instance, consensus GDP growth, consensus earnings growth, trailing one-year returns, treasury bond yields, trend earnings growth, GDP, all that kind of stuff has less predictive ability than rainfall. Do you know how many hours I spend on all that stuff? A little bit of a slap in the face. Basically, the purpose of this study is to demonstrate that the only thing that matters in predicting future stock market returns is valuation. Those of you who were in the office sometime middle of the year last year when Spain was trading at 4, and I see Chad somewhere up there, we had a lot of conversations about this. If you had any guts, you would have bought Spain trading at 4 times earnings, Greece trading at 2 times earnings, because you just assume they're going to survive. And according to this analysis, those would have been prudent decisions. Y'all would have all fired me, but they would have been prudent decisions. Okay, so knowing that all that matters is valuation, let's take a tour around the planet. This is the U.S. This is a 5-year normalized PE on the U.S. So just think about it from a relative standpoint. The long-term median going back to 1926 from a PE perspective is about 16.5. Today we're trading at 19.5. So based upon this logic, U.S. valuations are somewhat stretched. What about outside the U.S.? So this is the PE outside the U.S. in the developed markets. Think Canada, Europe, Japan, etc. So again, the long-term average trues up to a divine 16.5%. Outside the U.S. in the developed markets, we trade at about 14 times earnings. So below its long-term average, and compare that with 19.5 times here in the U.S. What about the emerging markets? Well, the emerging markets, again, about a 17 times median PE over their history, are currently trading at about 14.5 times. So just to review, the U.S. is growing slowly, and valuations are somewhat stretched. The developed world outside the U.S. isn't growing at all, but it's cheap. The emerging markets, Asia, etc., are growing swiftly and also cheap. So now let's predict future stock market returns. For that, I'll rely on somebody else's opinion. This is Jeremy Grantham's work. He runs Grantham Mayer. They oversee $100 billion. He's got a lot of money riding on these forecasts. And so he says basically over the next 7 years, again, stemming off of the valuation work we just said, the U.S. large company stocks will return about 3%. By the way, I added inflation in here, so your net return on that would be 0. U.S. small cap stocks would return about 2.2%, and then, of course, Jeremy Grantham's high quality index will do very well. U.S. high quality does 8%. Thank you, Jeremy. Outside the U.S., though, what you can see clearly is that valuation matters. So the expected rate of return for the international markets, large and small company stocks developed, is about 7%. And then if you look at the emerging markets, the forecast is for about 8.5% over the next 7 years on an annualized basis. And then you look at the bond market, and basically this says no returns whatsoever. So just to put it in order, Jeremy says emerging markets, number 1, international ex-U.S. markets, developed ex-U.S. markets, number 2, the U.S., number 3, bonds, number 4. With that as a backdrop, what are we doing? So currently, in our portfolio, and the firm really started in 1986, so we've been managing money since 86. I've had control since 2002. This is the least amount of U.S. stock exposure we've ever had. So currently, we're 46% allocated to the U.S., 4% sitting in underlying cash. We are 38% in developed ex-US, 12% in emerging markets. And to the extent that we make changes into the portfolio using that macro thesis as a guide, I would imagine we'd rotate even further offshore. Now again, that doesn't make me any less patriotic. I love the stars and bars. But based upon the valuation metrics I just shared, the relative opportunity is greater offshore. So what's our forecast for 2013? We think it's time to return to our animal spirits, per se. And because of that, having resolved our mid-cycle crisis, and now we've got this wave of optimism, we expect equities will go to new highs. I sat on the couch for 2 hours today, waiting for the Dow Jones Industrial Average to get there. It got 20 points away, and then somebody hit a sell program, wasted my 2 hours. But anyway, I wanted to be able to report that we hit new highs today. We'll get there. In terms of size, with surge in optimism, we expect risk appetites to favor small companies over large companies. We're positioned accordingly. In terms of style, typically in early cycle or mid-cycle recoveries, value-styled investing tends to outperform growth, and so we predict that to be the case. In terms of domicile, for the reasons I just shared, we're expecting internationals to outperform domestics. In terms of U.S. interest rates, this is beating a dead horse, but I expect long rates to go higher. In terms of the U.S. dollar, just again to point at the currency war, I don't think Europe is willing to grow its balance sheet at their central bank as much as we are, and so I think the dollar goes lower, specifically against the euro. And in terms of bonds, I do believe that interest rate-sensitive bonds are terminal. Just to put that in perspective, if you own a 10-year Treasury bond today, and it's yielding 1.9%, if that yield goes to 2.9%, and by the way, the long-term average is 5.5%, but if that bond goes and yield up 1%, it equates to a 9% loss on your investment. So we're staying away from those. In terms of primary threats, oddly enough, I think the primary threat to this thesis is a surge in confidence that leads to a spike in inflation and interest rates, makes the Fed active, and that spooks investors.